Before we begin our discussion of the new revenue recognition standard, let's go back to where this project began and answer the question, why in the world do we need a new revenue recognition standard? Let's begin by thinking about the concept of revenue. While numerous thoughts may come to mind, at the core, revenue is what makes companies tick. It's their lifeblood. Whether you're looking at it from a company's perspective or as an outside financial statement user, revenue is one of the most important financial metrics. But how and when do you recognize it? At the surface, this may seem like a simple question, as a large number of revenue transactions are rather straightforward and don't stir up much controversy in mainstream accounting circles. However, all transactions aren't this way. For example, some customers may pay at a different time than when they receive goods or services. Or, some customers may enter into a single contract that contains a variety of goods or services. These contracts aren't so simple. When looking at the current revenue recognition standards, the model driving recognition is one that focuses on when a company earns revenue by providing the goods or services promised to the customer. In practice, this approach has led to companies arriving at different recognition determinations for economically similar transactions. This disparity also impacts comparability of revenue among different companies and across different industries. If you're like me, you might be starting to question the usefulness of this approach. But that's just a high-level view of the current guidance. To further these thoughts, let's dig a little deeper into some specific US GAAP and IFRS considerations. Presently, US GAAP has very complex and detailed revenue recognition requirements. In fact, there are more than 200 authoritative pronouncements. Yes, 200 pronouncements, ranging from general recognition guidance to more specific transaction and industry guidance. Why so many? Well, this guidance was released at different periods of time in response to specific transaction or industry concerns. The result is a patchwork set of rules-based standards for recognizing revenue. This has led to inconsistencies in the accounting for different industries and different transactions, even though they may be similar from an economic standpoint. To illustrate, let's look at an example. Consider a cable television provider. It charges its customers separately for installation, as well as a monthly fee for continued access to the network. Should this company recognize revenue when it initially connects a customer to the cable network? Or should it recognize revenue over the subscription period? The answer is both. The installation services are a separate earnings process, and revenue is recognized when these services are rendered. The monthly fee would be recognized as a separate revenue stream over the subscription period. Let's compare that approach with a telecommunications provider. Similar to the cable provider, this company charges its customers an upfront activation fee, plus monthly fees for continued telephone usage. So, should this company recognize revenue when it initially connects a customer's phone to the network? Or should it recognize revenue over the contract period? Well, it seems like this service is similar to those provided by the cable provider we just talked about, right? Well, not so fast. According to the current guidance, a telecommunications provider would not account for the connection services as a separate earnings process. Instead, the combined fee for activation and ongoing service is recognized evenly over the service period. Confused? So are we. In addition to these inconsistencies, you may also come across black holes where no guidance exists. These pop up from time to time despite the numerous standards we've mentioned. Anyone who's ever searched for guidance on service transactions knows what I'm talking about. Okay, so what about IFRS? Well, if US GAAP has too much guidance, IFRS is on the other side of the spectrum and currently has very few standards on revenue recognition, and lacks guidance for specific areas, such as multiple element arrangements. In the IASB's quest to create a pure set of accounting principles applicable to all companies, they also strategically avoided industry-specific guidance. While this achieved the goal of avoiding rules-based guidance, the resulting principles are difficult to apply to specific and emerging transactions within certain industries. The other issue with IFRS is that the guidance that it does have sometimes arrives at accounting conclusions that, once again, don't match up with the economics of the transaction. This is due to the fact that revenue from the sale of goods is primarily driven by the transfer of risks and rewards of ownership from a vendor to its customer. This consideration differs from the concept of control, which drives the recognition of assets. On top of this, applying the methodology to contracts involving both goods and services creates added complexity and ambiguity for revenue recognition. So, whether you're coming from US GAAP or IFRS, you can see that the existing guidance is less than ideal and, in some views, in desperate need of a facelift. In both cases, the guidance has often led to inconsistencies in financial reporting. So the big question is, what do we do? Well, in hopes of addressing these issues, the FASB and IASB put their heads together and began to work on developing a single model to apply to all types of revenue transactions. They began this project way back in 2002 and discussed a variety of different approaches and models to improve revenue recognition. Ultimately, they ended up with a single, contract-based model that is founded on one recognition principle to allow for scalability. In summary, this principle is that companies should recognize revenue as they fulfill their promises to provide goods or services to their customers. To achieve this core principle, companies will apply a 5-step model that we'll discuss in today's module. Through issuance of this new standard, the FASB and IASB hope to remove the inconsistencies and weaknesses that are present in the existing revenue guidance. They hope that by creating a more robust standard that is also somewhat fluid, it's capable of addressing revenue transactions entered into today, as well as those future transactions that we haven't even begun to consider yet. There are some drawbacks, though. This move towards a global principle of revenue recognition has come at a cost of increased judgments and estimates. And adopting the new standard is no small task. But the boards recognize this. The transition period, which was already a little longer than usual, has been postponed, and they've convened an implementation group to assist in the process. With that being said, companies need to begin determining the impacts of the new standard to their organizations today in order to achieve a smooth and successful transition, particularly as it will affect much more than just their financial statements. The new standard will have a pervasive impact throughout the entire organization. With so much change on the horizon, let's not waste any time. Let's dig right into the new standard now.